Welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today at a earnings-based call calendar we just did this morning based on Nvidia, which, as everyone probably knows, reporting after the close today, all eyes on Nvidia. But really taking a look at a comparative from this earnings to last earnings, right, at that call calendar, a similar trade, but how much cheaper it is now, because not all IV is the same. The long-term IV has dropped, not as much point-wise, but the point drop is more meaningful the longer term you go out. So let's jump in and take a look at why we took this trade to find risk. So here is the call comparative kind of trade going back to last earnings from May 20th, right? We can see that the stock closed right the day basically before earnings, right, at 220.61. You could see the 235 may call about 15 points out of the money, right, would be the one we're selling, right, 2 days to expiration. The one buying 23 days to expiration, the June 12th 235 call, trading at about $5.45. So able to sell almost 100 IV, hedge with about a 48 IV. You can see that that call calendar trading a little bit over $3 at $3.15, give or take. Fast forward to basically this morning, if you will. This is from last night's close, right? Stock Nvidia 213.05, so a little bit lower, right? We lowered the strikes accordingly, right? So now the 227.5 calendar instead of the 235, the stock roughly about 7.5 points lower. So identical trade, 2 days to expiration on the one we're selling, 23 on the one we're buying. We can see we're selling only a 92 IV instead of back here selling almost 100, right? So giving up a little there, but making it more than back, able to buy under a 42 IV. Back here was almost 48. The actual term structure valve steepened a little bit, but because this is longer term, that move, right, is more meaningful price-wise. So I kind of put 2 and 2 together here. You can see that that calendar now trading about $2.30. Before it was over $3. The same exact calendar, same time to expiration, same amount out of the money, but able to get in basically about 30% cheaper. So back pre-last earnings, right, the stock was at 220.61. The strike, 235 strike, was a little over $14 out of the money, 6.5%. The short call at 229, the long call at 545. So the Cali trading about 315 and able to sell almost, as we said, 100 by about a 48, so 52 point roughly term structure vol differential, which is simply the IV difference between the one we're buying and the one we're selling. Fast forward to the trade we just did, right, based on yesterday's close. The stock closed at 213.05, so we chose the 227.50, basically the same amount out of the money. Stock dropped 756, so we chose one that was 750 lower, pretty much the same out of the money amount within a rounding error, right? The short call now dropped 44 cents to $1.85, right? But the long call dropped $1.33 to 412. Why? Because we saw the IV on the long call drop over 6 vol points. The short call did drop more vol point wise, right? But percentage wise, certainly much less, right? And that's really the key. Plus, longer term has a more meaningful price impact. So even though the term structure vol got a little bit less steep, right, the trade got a lot cheaper at $2.30, give or take. So we elected to jump in and do that trade. Why we chose 230 or 227 in this case, right? You can see here's 227.50 on the chart. Absolute overhead resistance for Nvidia bumped up against there several times. We'll see what it does post earnings, no guarantee, but should be some overhead resistance on that one. Also taking a look at the expected move, right, you can see only looking, at least from this morning, about a 5% expected move based on earnings, right? So the upper price based on that would be about 222.50, so well below the short strike price. You can see implied volatility again, that big differential, right? Able to sell about 100, as we said, hedge with about a 44, somewhere in there, depending on what actual fill prices you get. Here's our actual fill from the trade, right? So able to get in at 229 net debit, right, buying the September 227.5 call, selling the August 28th that expires this Friday, 227.5 call, right? So you'd be 9 deltas net long. Ideally, you see Nvidia move towards that 227.50 level, right? Which is this area on the chart would be perfect, right? In overhead resistance. So that's why we chose that as well. And you can see our term structure vol we captured on the actual trade. We're able to sell a 97 roughly, hedge with about a 43. So capturing about 53.5 points. Nice term structure vol difference. The one thing you do know is post earnings, when the unknown becomes known, that term structure vol will flatten a definite benefit. And also, say the stock doesn't head towards the ideal price, say it goes down, right? We have all these weeklies, right? Not even weeklies, they expire every 2 days in Nvidia, but we have all of these other ones to continue to sell against our long September 18th call, so we can continue to chop wood as well. So that's why we took the trade here. We'll see what becomes of it post earnings. The most you can lose is obviously what you pay on the trade, so defined risk of about 230 bucks. We're willing to live with that, right, to basically hedge our trade and capture that nice term structure of vol edge and lean a little bit bullishly post earnings for Nvidia. So we'll see how it fares. We'll give you an update, and as always, here's the good trading.